Welcome back to Alpha Recap. Markets were closed on a mixed note today. Pockets of clear winners and some clear losers. And we're going to walk through what moved the tape and why. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Lots to unpack. Corporate deals, AI headlines, crypto flows, plus some policy noise that really mattered.
So, what really stands out here is that the day didn't have one single narrative. It felt like a series of sector stories happening at once.
Exactly. You had clear outperformance in materials and industrials tied to real economy projects, while crypto, parts of utilities and cannabis, ran into headwinds. Technology was center stage, but with legal and policy caveats.
Let's start with the winners. Materials and industrials. Big headlines there, right?
Right. Materials got a lift from ongoing lithium ramp-ups, some antimony price moves, and new tungsten projects. There was also takeover chatter around BlueScope and fresh drilling and plant contracts that pushed miners higher.
I mean, when you step back and look at this, the story is straightforward. Demand from electric vehicles and energy storage is real, and near-term supply tightness is supporting prices.
Exactly. That combination gives producers pricing power in the near term and makes M&A, mergers and acquisitions, more likely in this space.
Industrials had a banner day too. There was a $4.2 billion shipping deal and a $1.3 billion plant investment that made headlines.
Those are the kinds of transactions that translate into capacity improvements and order book visibility. Consolidation in shipping often means better pricing power for carriers and improved margins for equipment suppliers down the line.
Real estate also showed strength. Leasing wins, land deals, and seller financing programs. That was a bit of a surprise to some.
Honestly, I was a bit surprised by this one, but it makes sense. High quality, well-located office and logistics assets still command demand. And when you see corporate lease extensions and conversion wins, that signals durable cash flow for those owners.
Right. Okay, flip side, the underperformers. Crypto caught a lot of attention.
Yes, Bitcoin and Ether both slipped in a cyclical move, and there were outflows from Bitcoin exchange-traded funds. The number that really caught our eye was $105 million of outflows.
Not a great day for crypto. There was also an Oracle failure and some fund-level losses that fed into the caution.
Those operational issues are the kind of reminders that crypto still moves on liquidity and execution. Wells Fargo also flagged a possible $150 billion of retail flows in the long run, which is interesting, but it's theoretical until flows show up consistently.
Utilities were mixed too. Some big asset buys and transmission wins, but offshore wind setbacks and permitting headaches made headlines.
Right. And the other thing is that long-dated projects in utilities depend heavily on stable policy. A $1.9 billion asset purchase looked good on paper, but cancellations and regulatory friction offset that optimism in parts of the sector.
Cannabis had a patchy day as well, with state-level ballot wins in some places, but fresh regulatory risks in others.
Yes, wins in Virginia, Nebraska, and South Dakota were positive, but new uncertainties in Arizona and Massachusetts meant the risk-reward stayed murky for many multi-state operators.
Let's dig into technology, since AI dominated some headlines.
Technology saw support from AI benchmarks and low-energy AI chip news. The big item was a reported multi-year arrangement between Meta and NVIDIA, which reinforces the demand story for data center GPUs and AI infrastructure.
And that has spillovers, right? More GPUs mean more data center buildouts, more power needs, and more demand for materials and transmission upgrades.
Exactly. AI is an organizing theme across several sectors: communications, industrial automation, energy. So CapEx flows can ripple through copper demand, rare earths, and even logistics for supply chains.
But it wasn't all upside. Legal risk around training data and content rights was a real brake on enthusiasm.
That's right. Litigation and studio disputes are real catalysts that can affect monetization timelines for AI products. Investors were cautious, pricing in the possibility that courts or regulators could force changes to how models are trained or how content is used.
Speaking of big CapEx plans, the Adani announcement was eye-popping. $100 billion for renewables and AI data centers.
Big indeed. That's the kind of headline that reshapes regional infrastructure demand. If executed, it would drive long-cycle contracts for construction, materials, and grid upgrades.
Which brings us back to the theme. Energy transition links materials, industrials, and energy policy.
Yes, miners producing lithium, tungsten, and antimony are reacting to secular demand from EVs and batteries. Industrial investments, plant builds, and expanded uranium capacity reflect moves to secure supply chains and translate resource potential into deliverable output.
Quick reactions now. Wow, big day. Yeah, that tracks. Let's move into the actionable part. What should investors be doing in the next 3 to 12 months?
Tactically, a modest overweight to materials, maybe 3 to 5% relative to a benchmark, made sense for this window. Favor producers with exposure to lithium, tungsten, and antimony, and those with near-term production ramps or contracted offtake.
And industrials?
Select industrial manufacturers and logistics names tied to capacity expansion and shipping consolidation looked attractive. The $4.2 billion shipping deal we mentioned points to improved utilization and potentially steadier freight rates.
Real estate. You said pick high-quality, well-leased office assets and logistics REITs.
Yes. In markets where supply is constrained and tenants are stable, those assets can provide durable cash flow. For logistics, e-commerce, and supply chain investments continue to underpin demand.
What about technology leaders?
Hold market leaders in AI infrastructure. NVIDIA and Meta were obvious names that benefited from the headlines, but size positions carefully. Legal and policy risk around data and IP is non-trivial, so risk controls were important.
Crypto. Any tactical ideas?
For risk-tolerant investors, small exposure to regulated crypto infrastructure, custody providers, established exchanges, made sense over spot coins right now. The $105 million of ETF outflows and the Oracle failure pointed to operational fragility in the ecosystem.
And utilities?
Favor regulated rate-based utilities with predictable growth and strong balance sheets. Be cautious on merchant renewable developers that are exposed to permitting risk or subsidy uncertainty.
Cannabis. Reduce or avoid speculative names.
Yes. Where state-level wins were offset by regulatory risk, it made sense to trim cyclically exposed holdings. Multi-state operators without diversified footprints were more vulnerable.
Portfolio construction notes. You recommended reweighting toward real economy cyclicals by 3 to 5 percentage points, funded by trimming speculative tech and unhedged crypto positions.
Correct. And keep some dry powder, 5 to 10% of the portfolio in cash or short-duration bonds to buy into policy-driven pullbacks, especially in sectors like utilities and cannabis, where regulation can create entry points.
Let's quickly go through the top risks to watch in the next few weeks.
First, regulatory headlines. Litigation around AI training data and content rights could move tech stocks in single-day bursts. Second, macro liquidity and Fed signals. A risk-off move on rates would pressure tech and crypto more than the industrials tied to real projects. Third, commodity and supply shocks. Drilling results and plant commissioning timelines can change the outlook for materials quickly.
And corporate execution. Delays in big projects like plant builds or the Adani plan could test capital markets' patience.
Absolutely. Execution matters. Announcements are one thing, timely delivery and funding are another.
3 quick takeaways to close out.
1. The market was bifurcated. Capital was flowing into companies converting resources into repeatable earnings, like materials and industrials. 2. AI remained a durable tailwind, but was complicated by legal and IP risks, so protect sizing in tech names. 3. Crypto and cannabis stayed high volatility sleeves. Treat them opportunistically, not as core portfolio anchors.
Solid. Final sign-off and a reminder. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening.
Thanks. Talk soon, and we'll watch next week's policy and earnings headlines closely.